When people hear the word stock market, most imagine Wall Street, flashing screen, traders shouting, and billion-dollar deals. But the stock market is far bigger than one country, one exchange, or one continent. From New York to Nairobi, from London to Lagos, stock markets shape economies, create wealth, and influence our daily lives. In this video, you'll learn how African and global stock markets work, the major indices, what moves prices, how to analyze markets, and what the future holds for investors worldwide. The African stock market refers to a network of stock exchanges spread across the continent. Unlike developed markets, Africa does not have one single exchange. Each country operates its own. These markets allow companies to raise capital, governments to attract investment, and citizens to grow wealth. African markets are often classified as frontier markets. Smaller, less liquid, but full of growth potential. They are influenced by economic development, political stability, commodity prices, and foreign investment flows. As Africa's population grows and economies modernize, these markets are becoming increasingly important. To measure market performance, stock exchanges use indices. An index tracks the value of selected companies and shows whether a market is rising or falling. Africa's largest exchange is the Johannesburg Stock Exchange in South Africa. Its main indices include the FTSE/JSE All-Share Index and the Top 40 Index. Nigeria follows with the NGX All-Share Index, representing Africa's biggest economy. In East Africa, Kenya's Nairobi Securities Exchange uses the NYSE All-Share Index. Egypt and Morocco also operate some of the most active markets in North Africa. These indices reflect the health of African businesses, industries, and economies. Stock prices in Africa are driven by powerful forces. Economic growth plays a major role. When economies expand, companies earn more profits. Political stability is critical. Elections, policies, and governance can move markets quickly. Commodity prices are another key driver. Oil, gold, copper, and agricultural products directly affect many African economies. Currency strength matters, especially for foreign investors. Interest rates influence whether money flows into stocks or bonds. Finally, foreign investors have a strong impact. When global confidence falls, African markets often feel it first. Interest rates are the foundation of modern financial markets. They represent the price of money, the cost of borrowing today instead of tomorrow. And whoever controls interest rates controls liquidity in the economy. Central banks use interest rates as a policy tool to either stimulate economic growth or slow inflation. This single decision influences businesses, consumers, banks, and investors simultaneously. When interest rates are low, borrowing becomes cheap. Companies can take loans to expand operations, buy equipment, hire workers, or invest in innovation. Consumers can afford mortgages, car loans, and personal credit. Economic activity increases. As company revenues and profits rise, stock prices rise with them. At the same time, savings accounts and bonds offer low returns. This pushes investors toward stocks in search of higher yields. When interest rates increase, the opposite occurs. Loans become expensive. Companies delay expansion. Consumers reduce spending. Debt-heavy firms struggle with higher interest payments. As profits decline, stock valuations fall. Meanwhile, bonds and fixed income investments become more attractive. Money flows out of stocks, and markets decline. This is why stock markets often fall immediately after interest rate hike announcements. Not because companies collapse overnight, but because future growth becomes less attractive. Inflation is the gradual increase in the prices of goods and services. It silently erodes purchasing power. What cost $1 yesterday may cost $2 tomorrow. For stock markets, inflation is a double-edged sword. Moderate inflation signals growth, but high inflation destabilizes the entire financial system. As inflation rises, companies face higher input costs, raw materials, energy, wages, transportation. Unless they can pass these costs to consumers, profit margins shrink. Consumers facing higher prices reduce discretionary spending. This directly affects company revenues. High inflation forces central banks to raise interest rates. This tightens liquidity, slows borrowing, and reduces economic activity. Stock markets react negatively long before the real economic damage becomes visible. In extreme cases, we have hyperinflation and deflation. Hyperinflation destroys savings and collapses investor confidence. Deflation, on the other hand, discourages spending and investment. Both scenarios are toxic to stock markets. Stock markets are built on confidence. Political instability destroys confidence. When governments are unstable, investors cannot predict the future rules of the game. Political instability introduces uncertainty in taxation, regulation, property rights, and trade policies. Foreign investors fear sudden changes, capital controls, nationalization, or hostile regulations. As a result, capital exits the market, currencies weaken, stock prices fall. Even after stability returns, trust takes years to rebuild. Markets remember instability long after headlines fade. Speculation occurs when investors buy assets not based on fundamentals, but on expectations of future price increases. It is driven by emotion, not logic. As prices rise, more investors rush in. Fear of missing out replaces rational analysis. Prices detach from real value. Eventually, reality intervenes. Earnings fail to justify valuations. Confidence collapses. Prices crash violently. Fundamental analysis focuses on value. It examines a company's revenue, profits, debt, cash flow, and management quality. Investors use ratios like price to earnings, return on equity, and earnings per share to judge whether a stock is undervalued or overvalued. This approach is best for long-term investors. Technical analysis focuses on price movement. Charts, trends, support, and resistance levels help traders time entries and exits. This method is popular among short-term traders and swing traders. Macroeconomic analysis looks at the bigger picture: inflation, interest rates, GDP growth, and global events. In African markets, macro factors often outweigh company-specific details. Global stock markets connect investors to the world's largest economies. The United States leads, followed by Europe and Asia. Markets in New York, London, Tokyo, and Shanghai influence global capital flows. Because of their size and liquidity, U.S. markets often set the direction for the rest of the world. When major global markets move sharply, African markets usually follow. Index funds have transformed investing. The S&P 500 tracks 500 of America's largest companies and has historically returned about 10% annually over the long term. The NASDAQ 100 focuses on technology and innovation, offering higher growth but greater volatility. The Dow Jones Industrial Average tracks 30 established companies and is more conservative. Total market index funds provide exposure to the entire U.S. economy. Every day, trillions of dollars move across global stock markets. Prices rise, prices fall. Some investors build wealth over decades, while others lose fortunes in days. But stock market movements are not random. They are driven by powerful forces: economic, political, psychological, and structural. With this said, we will revisit the 2008 financial crisis, a moment when nearly the entire global financial system collapsed, and understand how it reshaped stock markets forever. The 2008 financial crisis was not an accident. It was the result of years of excessive risk-taking, weak regulation, and misplaced trust. Banks issued mortgages to borrowers who could not afford them. These loans were bundled into complex financial products and sold globally. When housing prices fell, borrowers defaulted. These financial products collapsed in value. Banks stopped trusting each other. Credit froze. Lehman Brothers collapsed. Panic spread globally. Stock markets crashed. Trillions of dollars in stock market value vanished. Retirement accounts collapsed. Unemployment surged. Confidence in the financial system was shattered. Markets are not driven by luck. They are driven by structure, policy, and human behavior. Those who understand interest rates, inflation, political risk, and speculation do not panic. They position themselves. History does not repeat itself exactly, but it always teaches. The future of stock markets will be shaped by powerful forces. Technology and artificial intelligence are redefining industries. Emerging markets, especially Africa and Asia, offer long-term growth driven by young populations. Sustainable and green investing is becoming mainstream. At the same time, volatility is increasing due to geopolitics, climate risks, and global debt. The stock market will continue to reward patience, education, and disciplined investors. Understanding stock markets is no longer optional. It's essential. Whether in Africa or globally, knowledge gives you an advantage. If you found this video valuable, like, subscribe, and share it with others. The journey to financial literacy starts with one decision.